Hey, good morning, everybody, and welcome to this latest Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats. It is Tuesday, October 28th, 2025. First of all, from a purely historical perspective, this is a great day. We move out of the bearish historical period. Really didn't notice that there was one this year, but usually the 21st through the 27th is historically a bearish period, the worst bearish period of the year for the S&P 500, and that data dates back all the way to 1950. So certainly something to at least consider every year. As I mentioned, going into it, it doesn't go down every year. I think over the last 75 years, that period's gone up 31 times and down 44. So it certainly has the tendency to go down, but not a guarantee. And this year didn't. We saw a relatively strong period. And now we're moving into the most bullish period of the year, both on a short term and a longer term basis. The upcoming 10 days. So from the October 27th close through the November 6th close is arguably the best period of the year. So literally it's like, turning off the cold water and turning on the hot water in terms of history as far as last week and the next 10 days go. I always found that to be really fascinating when I was studying history. But the next 10 days do tend to be very strong, very bullish. But also this October 27th close marks the longest, one of the most bullish long stretches of the year, where from October 27th close through January 18th, has historically been the best period of the year. I mean, to take that kind of an extended period, it's got I believe, an annualized return of about 21%, which is more than double what the S&P 500 normally averages each year. The average is 9%. So when I talk about annualized returns, if it was just going along for the ride, kind of like how the S&P 500 does throughout the year on average, then any period I look at would have an annualized return of about 9%. When you start talking about an extended period like this, where you've got annualized returns of over 20%, that's pretty significant, I think, statistically. And so something to think about. Over the last 75 years, the January 18th close has been higher than the prior October 27th close 65 times at the last 75 years. Only 10 times since 1950 have we seen the market go down from October 27th to January 18th. So doesn't mean it doesn't go down, up and down throughout the period. I'm just saying, looking at the closes, January 18th versus October 27th. I think that's something to at least consider for those of you thinking, hey, we're heading into a bear market. That history would say no way. Very, very unlikely at this point. When you're setting all-time highs on October 27th, there's a pretty good chance you're going to see some more all-time highs coming up. That's the way I would look at it. And fundamentally, earnings are coming in very strong. And you've got that combined with lower interest rates. The Fed meets starting today. They're going to have an announcement on Wednesday at 2 p.m. It's widely expected they're going to cut another 25 basis points. And so we'll see how the market reacts. But I believe over time, we're going to continue to see the market move to the upside. Before I say anything else, I do want to say all of our thoughts and prayers with those in Jamaica. My gosh, this hurricane. I really I find the weather to be very fascinating. Maybe because I do stock trading and it's very similar, but not in the literal sense, obviously. But that Category 5 hurricane bearing down on Jamaica. Jamaica is one of the islands I've been to many, many, many times. And I honeymooned there, had friends. We would gather and go there just about every year for many years. So I'm very familiar with the Montego Bay area. And it looks like they're about to take a direct hit from one of the biggest hurricanes in the history of weather. So anyway, thinking about all the folks down in Jamaica and everyone impacted by that. All right. Let me go ahead and share my screen with you. I haven't done that yet. Let's go ahead and take a look at what happened yesterday. And then we'll kind of see what we might be able to expect, not only today, but over the next couple weeks, couple months, and so forth. Dow Jones Industrial average yesterday closing above 47,000 for the second time, tacking on to the gains prior, now within an earshot of 48,000. When we crossed over 45,000 and broke out on the Dow, I talked about the fact that it measured up to about 50, I think it was 53,000. I think we're on our way there. I believe the Dow Jones is going to 53,000 on this measurement. I think ultimately it's going a lot higher than that, but I'm talking about in the relative near term, within the next 6 months, probably, maybe sooner. I believe the Dow will be at 53,000. S&P 500, 6875. Seems like these 100-point increments just keep coming and going one by one. Now we're within 25 points of the first close at or above 6,900. We finished yesterday up 1.23% on the S&P 500. And those who thought maybe my 7,000 target on the S&P 500 was outlandish, especially back at the beginning of April, when we were in the midst of that, what turned into a very brief bear market, and we saw the S&P at 4,800. Probably not too many folks thought we would see 7,000 by the end of the year. I never wavered. I thought we would be at 7,000, and we're almost at 7,000. NASDAQ, 23.6, up 432 points. That was up 1.86%. Really strong day for many of the Mag 7 stocks. Saw a big gap up, big move higher in Microsoft and some of the others. S&P 400 mid cap up 1/3 of 1%. S&P 600 small cap. This was interesting because at the beginning of the day, small caps, I believe, were actually up higher than the NASDAQ. But it was kind of a flip throughout the day. Money was rotating toward many of the larger companies and away from a lot of the smaller companies. So we did finish just barely down, fractionally lower on the S&P 600 small cap. Volatility index now down below 16, down 3.5%. It wasn't that long ago. We were up well into the 20s, mid upper 20s. Now here we are back down under 16. I kind of look at that 17 to 20 range. I could stretch it down to 16. 16, 17, I think, is always key area. If you are thinking, hey, this is perhaps going to morph into a bear market. Well, we've never had an all-time high where we've seen the market come down, the VIX shoot up above 20, have a bear market, but during the bear market, see the VIX go back down below 16. Now, some have argued, well, that's not true back in the 2000s. Well, that was a secular bear market. And we had a bear market, then we had a cyclical bull, and then we had another secular bear market. I'm talking about within the confines of one big 20% or more drop. When you fall and you start to fall and that VIX goes over 20, like it did a week or two ago, we have never seen a bear market continue if the VIX goes back down and drops below 16. I don't want to use the analogy of a hurricane, but any kind of a bad weather event. You need certain conditions in order for a hurricane or a tornado or something like that to take effect. You can have lots of thunderstorms that don't have any kind of possibility of a tornado. But then there's some, they say, hey, in this particular area, there's rotation, there's wind shear, there's whatever you need. And there's like a 30% chance within this range that we'll see a tornado. That's kind of how bear markets work. You need a certain amount of fear. You need certain elements to have a bear market. And I'm just saying the volatility index, the VIX dropping below 16, the bear market, if you're thinking bear market, well, you ought to be not thinking bear market anyway, because we've now gone back up to new all-time highs. That also negates a bear market. If you think you're starting a bear market with the S&P at 6,800 and the S&P goes to 6,900, that's not starting a bear market at 6,800. So, overall, another really good day in the market yesterday to end what, as I mentioned earlier, historically is a pretty bearish period. Historically, the worst week of the year. Looking at the S&P 500 and the stocks doing the best, I found this one to be very interesting. Qualcomm, I think it opened up well over 200 and then came back to 187. Um, I don't know. I kind of call it a wannabe AI company. They came out and made announcements that they're going, getting into the AI and that their revenues were going to be such for AI, and kind of reminded me a little bit of what Oracle did a few months ago, except Oracle was actually uptrending heading into that. Qualcomm's been doing nothing for about 5 years. It goes up and down, but really, I mean, if you look back 3 or 4 years from now, there was a peak where the stock was trading right around 170, 180, and which is basically where it is right now, even after that announcement yesterday. But after the announcement, stock soared, and then it was being sold off all day. Just not really a good look. And again, when you start forecasting things out into the future and you're not really performing well now, I don't know, it feels like you're grasping at straws to me. Anyhow, Qualcomm did have a good day, best performer in the S&P 500, but more than that was at the opening bell, and then selling kicked in throughout the day. As far as what didn't work yesterday, you can see ALB, NEM. So we got Newmont Mining, which since coming out with earnings has really been struggling. It was up around the $90 level, I think 89 when it reported earnings, went down to about 82. Now down another $4.78. Not really a good look there. Got a few, FFIV, which took a little bit of a hit yesterday, is going to take even a bigger hit today. Unless things changed overnight, I will give you FFIV down $29 right now, almost 10% with its earnings that came out last night. So the market not impressed. FFIV, which already was not looking very strong. Let's go ahead and pull this up. Kind of see it already in a bear flag. It broke down out of the bear flag yesterday. Volume increasing. It was like maybe some folks had word of what was coming. I don't know. Stock down another 10%, down near 260 is where it looks like it may open today. Some other stocks in the news with earnings. I know Wayfair having a pretty nice reaction, up 14% after the bell yesterday. They reported earnings. I have not seen the earnings reports yet, so I'm not really sure where the numbers came in. I know Corning was getting hit this morning. It's down 5.5%. UNH was having a strong day. United Health Group, that's up 4%, back to 381. So pull up UNH, and you can see that is a potential breakout here above the recent high at 375. So if we do open at 381, it does look like we're off to about a 5-month breakout. I do see some overhead resistance potentially at this 375 level. That's where we got up to and couldn't get through. That was that gap resistance from the big drop back in May. So I think this is a good sign. Unless we get a big red-filled candle on UNH where we gap up and then just sell off all day long, I would think that this gap up, again, barring that kind of a sell-off during the day, I would think this gap up is going to improve the technicals here on UNH. All right, let's go ahead and take a look at the S&P 500. So the S&P breaking out again yesterday. I mean, here is that big red candle. I really thought, and this is the problem with getting bearish thoughts during a secular bull market. Many of them just don't. It never comes to fruition. But I really thought that was going to be like an A move to the downside. We'd get a little bit of recovery and a B bounce, and then we'd have one more leg down, a C. Never happened. We had the VIX up in the 20s. The conditions were ripe for some additional selling. And the bulls said, well, sorry, we're going right back up to new highs. Continuing to gap up. And by the way, once Wall Street has accumulated their shares, a lot of the gains do take place at the opening bell. Some might, if you have listened to me at bottoms, you know that one of the things I look for on market bottoms are big gap downs and then recoveries, where you're getting a lot of selling at the opening bell and maybe in the first 30 to 60 minutes of the day. And then we get big recoveries. And that to me is a sign that the bigger firms, Wall Street, they're starting to accumulate shares. Well, gap ups to the upside don't work the same. First of all, a lot of times you don't see gap ups with big selling. If we do, then yeah, that would be a little bit of a problem. But if you go back and you look and you did like a cumulative analysis since April, you would probably find that over 50%, maybe 60 or 70% of the net gains since the April low probably have come at the opening bell, the gap ups. And that's just the way the market works. Once Wall Street's got their shares and they're not accumulating anymore, they make the rest of us chase to try to get back in. That's just the way it works. So I'm not surprised when I see these gap ups to new highs. To me, it's just another signal that Wall Street's set. You know, they've already accumulated all the shares they need to accumulate, and now the stocks are just free to go to the upside. And so we get these runaway moves in a secular bull market. And it's really difficult if you're on the sidelines. NASDAQ 100, same thing, big gap ups, new all-time highs. Small caps. So here we got another, I think it was a closing, an all-time high yesterday on the IWM, because that did finish higher. Let me see if that is a all-time, I think it's all-time high close. The prior high close was 250.33. And we closed at 250.30. So we were 3 cents below an all-time high close on IWM. Intraday, we got to get through 252.77. Yesterday's high was 252.21. So just shy, but right on the verge, knocking on the door of another all-time high on small caps as well. And of course, the one group still not able to keep up, transports. I've mentioned before, I think I mentioned it on the weekend review that I did yesterday. Transports, the month of November, best month of the year for transportation stocks. I don't know if that's going to help. Nothing else seems to help, but it is worth mentioning. Transports do like the month of November. Industrials as a whole love November. So I'll give you a quick seasonality look at the XLI, which is the sector ETF that tracks industrials. And if we go back over the last 13 years, you can see XLI up 92% of November's now over the last 13 years. That includes this year. We haven't seen any trading yet in November in this year because it's not November yet. So this is actually over the last 12 years, 11 out of 12 years, the XLI has finished the month of November higher than it begins. That's pretty strong track record throughout this secular bull market. And the only other month that can, provide that claim is July. And if you look at the average returns, if we kind of zero in down here at the averages, you can see November 5.5% average return on the XLI over the last 13 Novembers. Well, last 12 Novembers. And the second best month is July at 3%. So November is almost twice as strong as the second best month. And if you look at the third best month, which is 1.8% in February, 1.7% in October, again, comparing that to November, 5.5%. Something about the month of November. The market historically does very well, and industrials are among the leaders. Now, if you want to do the seasonality and you want to see what is a relative leader, that's just telling us on an absolute basis. But we don't know what the S&P 500 does in November unless we add this right here, SPX. So now we're going to compare the XLI to the S&P 500 and see over the last 13 years, how often does the XLI outperform the SPX during November? And that's 83% of the last 12 years. So that's 10 out of the last 12 years. Industrials have outperformed the S&P 500. And the average outperformance is 1.6%. The only other month that's even close is February, which averages outperforming XLI, outperforms the S&P 500 by an average of 1.4%. So kind of interesting, good information to know, especially if you start to see certain areas breaking out. I know some areas that have been strong or have been strengthening within the industrials. We've got the DJUSHR. And I'm just going to look at one other thing over here. It just broke out. I was just looking to see. It's broken out to a new high. It's been pretty consistently moving up, this commercial vehicles group. And if we look at this over the last 13 years, you can see that it outperforms the S&P 500 roughly 2/3 of the time. So 8 out of 12 years, average outperformance 2%. So it's a strong month. This has been a strong group. So one of the things you can do is simply find out, okay, well, let me show you a way you can find out the commercial vehicle stocks. So if you go to scans, and let's just do a new scan, and then you hit this new, just gets rid of the default scan criteria. What you can do is come down here under sectors and industries and go down to the industrials and commercial vehicles and trucks right there. Add that. And what it'll do now is it'll give us all the stocks that make up that particular industry group. So I can run the scan. There are 46 of them. I can save this into a chart list. So I'm going to just put it into my scan results chart list. And then I can add in here my scooter. Actually, I'll put the industry. We know it's all, well, never mind. We know it's the commercial vehicles industry. We can do market cap. I'll throw scooter in there. Maybe volume wouldn't be bad, just to see what the volume is doing. And then we can go back and say, okay, well, look, how about the last week? It's going to give performance over the last week, but I want to do scooter order. So maybe what we can do is find a high scooter stock. This is StockCharts technical rank. So this is just a formula developed by John Murphy that it's a relative strength type of indicator. The only downside, the one limitation that I find with the scooter is that it's only basically looking back the last 5 months. So if you're a long-term investor and you want to find a stock that's been great for a long period of time, that maybe is pulling back or something, the scooter is not what you want to use. Because again, that's only really looking back over the last 5 months. You could have a stock that's been going down for 10 years and the last 5 months look good, and it'll be one of the top rated stocks. So you still need to go back and follow up, look at a long-term chart if that's what you're really looking for. But in terms of what we're doing, where we're trading and we're just looking for momentum and something that might work here over the next few weeks, I think this is a pretty good way to do it, because now we have the stocks that are doing the best in the last 5 months. So these are relative winners here at the top. You can go and look at the bottom if you want, but these are going to be stocks that are not performing very well. So I'm going to stick with these. CYD probably just jumped up there because of a huge week. It's up 18% this week. But something like Caterpillar is going to be reporting, I believe. I don't think they reported today. I will tell you in 1 second. Caterpillar reports tomorrow morning. But I actually think they could be, I wouldn't be surprised to see a pretty strong report just because of the way they've been trading. But that's probably not a great one. How about this Bluebird? Bluebird Corp down 4% over the last week, but it still has a 75 scooter score. See what that chart looks like. Well, it's pulling back and it's getting close to gap support. So I do kind of like this as it gets down closer to about $52. It's 53.14. Recent high up at 61.62. Next thing I might do is maybe go into seasonality and just see what BLBD, see if it does well in November. I have no idea. Let's go back 13. Well, it only goes back 12 years, but it is. November is the month that it goes up the most. And look at the average, 8% average return over the last 12 years during the month of November, 9% in May, 8.9% in February. I tell you what, it looks like it just likes the second month of each quarter. Sometimes NVIDIA is like this, but this is this is probably one of the most extreme seasonality charts I've ever seen in terms of performance during the second month of each quarter. 8.9%, 8.9% February, 9% May, relatively flat August, and then 8% November. I mean, if you add those up, that's 17.2, 25, 26.1, 26.1% average if you just owned BLBD during the second month of each calendar quarter. Which is kind of interesting because a lot of times the way stocks will work, like with NVIDIA reports toward, the latter part of November. So November goes up, like the second month of each calendar quarter tends to go up. But I always view it as being a Well, let me see when they report. I view it as being like a pre-earnings run, but maybe BLBD reports later in November. November 26th. This is a stock that loves to run into its earnings report. So, with that in mind, going back and looking at this, all of a sudden, I mean, literally starting with the scooter report, looking at one area of the market that likes November and is trading particularly well right now, use that scooter or, run your scan, look at it based on scooters, and voila, we got a stock that I think looks kind of interesting. Maybe it weakens a little bit, but knowing what I know now about that average going into November and knowing that earnings are just a week away, this is actually one of the stocks. This could be on I did not see this in my, oh, I know why I didn't see it, because it's probably not on the raised guidance chart list. But this could be a stock that I include for later for members, possible pre-earnings run. In fact, I'm going to jot this one down. So in case you're not aware, that's one thing I've promised the members today. I have not finished it. I was trying to finish it for this morning, but unfortunately I ran so many scans. I looked at so many charts and I just wasn't able to find much. But this is one that I will definitely add to it. I have 2 others right now. So I'd like to get up to about 5, and I will send those out this morning. But I'm just having to extend my search a little bit more than I did previously when I gave out the 10 stocks poised to run back on they were poised to make pre-earnings runs, but I gave those out back on October 7th, and they all but one have made runs of some sort to the upside. Some of them really big runs, like Dave. You can see this stock. We gave it out on October 7th. It was down around 200. It's now 256, making a nice pre-earnings run. All right, let's see. One other thing I want to talk about, technology. I mean, this is what's driving the NASDAQ and driving the S&P as well. And what is hurting on a relative basis somewhat, small caps. Money is still pouring into these large technology companies. 299, looks like we're going to go through the 300 level. I mean, we were in the 170s in April. Just a massive move to the upside. But I mean, it kind of makes sense if you've done valuations, because technology company earnings are exploding. I mean, if you look at some of these companies and what they're doing and what they're reporting and raising their guidance. So you're getting future earnings and cash flows that are going through the roof. And we're about to cut interest rates, which increases the value of all those future earnings. I mean, it's not surprising at all to me that we're having this kind of run up. Like I said, this is what I was calling for at the beginning of the year. This is why I thought the S&P would get to 7,000. I thought we would see lower interest rates, at least if not an improving economy, an economy where we were expecting it to improve going into 2026. I think that's where we are now. And many companies still able to produce some really strong earnings and increasing those earnings. And you throw that on top of lower interest rates. Yeah, I mean, I'm not surprised. I mean, we could continue to see a melt up here in the fourth quarter. I'd like to see it more on the small cap side, especially with rates coming down. But yesterday, it was all about the large cap. Semiconductors. You want to know why technology is doing well? Well, look at the semiconductors rolling. I can go down here and change this RSI. Let's do a price comparison. And right here, you can see the Dow Jones US Semiconductor Index breaking out to a new relative high. I mean, you can see here the absolute breakout, but it is also breaking out relative to the S&P 500. So this is a group that absolutely is carrying the market on its shoulders to the upside. Now, I just did that, with one particular industry group, but we actually have a chart list at Earnings Beats that I look at least once a week, usually more often than that, a couple of times a week, I would say. And that is the industry group relative strength chart list, because I can go in here and I can pull it up in summary form and I can see on a percentage basis what groups led yesterday. Automobiles, internet, steel, semiconductors, renewable energy. 5 strong areas. Steel, maybe not quite so much. It's been getting a little bit better. But renewable energy, semiconductors, internet, and automobiles, very, very strong areas. And we're continuing to see leadership there. That's just just one day. But then I can change this thing and say, okay, what's been leading for the last week? Here we've got computer services, renewable energy. You drop down to the 6th spot, semiconductors. There are 104 industry groups on this list. Semiconductors over the last week, number 6. How about over the last month? Semiconductors in the number 8 spot. How about the last 3 months? Semiconductors in the number, 12 spot. 6 months. Semiconductors number 2. Year to date, semiconductors number 8. 1 year. Semiconductors number, 11. So, I mean, almost any time frame you look at, basically you have a top 10 group, top 10% group in semiconductors. So lots of leadership there, continuing to see just gains piling on in those areas. And honestly, I just don't see it stopping anytime soon. Not with rates coming down and with projections and guidance being raised. I mean, unless we get some, real bombs coming up in earnings over the next couple of weeks, I think we're going to run through the balance of earnings season. Maybe we take a little pause second half of November around the holidays, but I think we'll probably maybe in a little bit of a shift, maybe toward more value in December, but I don't see the market coming down. If we didn't come down last week with the volatility index up in the 20s, I just don't know what it's going to take. All right. It is just after 9:30, so let's wrap this thing up. I do want to just mention, if you want to go over to earnings beats, if you want to get this report I'm about to release to members, start your no-cost 30-day trial. You can do that with that green button right here. I think have ended our flash sale that ended last night, but I'm sure if you wrote in this morning and, we're super nice, we'd probably extend it to you for this morning. But anyhow, scrolling down, if you're new to Earnings Beats, we do have a completely free, no credit card newsletter, name, email address, all it takes. We've had tens of thousands of folks subscribe to that. So if you want to check that out, by all means, do so. Also coming up in about 3 weeks, our new portfolios will be out. And if you've been following our portfolios, I did not update them for yesterday, but you can see our model portfolio for this quarter. And our quarters run kind of different. They're not calendar quarters. We wait until the end of earnings season, look at all the companies, decide what companies we want to put in our portfolios, and then we do it then. So this period is August 19th to November 19th. Next period will be November 19th to February 19th. So November 19th is when we start our new portfolios. But look at the last quarter. Model portfolio, 11.46%. S&P 500, 5.93%. Almost doubling. And look at since inception. How many folks out there have a 7-year track record where they are up 2.4% times the S&P 500? That's what we've done with this model portfolio over the last 7 years. Again, if you sign up for the trial, that's 30 days. That will get you all the way through the upcoming draft. I mean, that alone is a reason to be part of our membership for the next 30 days. Anyhow, that's all I have for today. So we're going to wrap up. Please like the video. If you are regular, we certainly would appreciate that. That'll help us on YouTube. Also, subscribe to our YouTube channel. We do a lot of free live stream events from time to time. If you are a subscriber and you turn on your notifications, as anytime we start a live show, you'll be notified, won't miss out on some of the great value that we provide just in some of these free events that we do. Anyhow, have a great rest of your day, everybody. Members, I'll be back to you later this morning. I'll try and get that out. Try to find a couple more pre-earnings runs I think we could see going forward. Then I'll send that out to you. Have a great day, everybody. Happy trading.